All right. It is 12:09. I'll call the meeting to order. And can the clerk do a roll call vote, please?
Mayor Alorza,
Present.
Vice Chairman Lombardi,
Present.
Councilman Igliosi, Councilman Igliosi, muted.
Present.
Ms. Silveria,
Present.
Mr. Costello,
Present.
Mr. Hirsch,
Present.
Mr. Winkleman.
Present.
We have 7 present. We have a quorum.
Great. Thank you. Thank you, everyone. Appreciate everyone's time and for being with us here today. I know that it's been a very topsy-turvy time with a lot of uncertainty. So, we're very eager to hear your report today, Eric. And, again, thank you to everybody for making time and being a part of this. I'll hand it over to you as we get started on part 1 of the agenda, investment performance analysis. Eric.
Thank you, Mayor. Thanks, everyone. It's good to hear from you. If you'll turn to your package, as we normally do, I'll give you the flash update. That would be page 1 of your package that was sent to you. You can see what has happened month to date through the 18th. You can see that markets have sold off pretty noticeably this month, in the first poor month in a while, post-pandemic. After a very strong run in July and August, especially, we've had a reversal this month, which I can talk about. You can see it's been especially heavy in the growth or the tech areas, the mega cap tech and the growth. You can see, for example, our passive exposure on the Russell 1000 growth index fund is down 8.1% month to date, but the value passive index fund is only down 1%. So that theme is holding true all through this month, and now growth is still massively outperforming value, but at least so far in this sell-off, it has reversed, and the sell-off has been concentrated in that area. So I think it's due to the fact that it had run so much. It's also due to the political situation that we're in. Markets were expecting and wanting some additional stimulus, and it looked like that was going to happen. It's more of a question of when than if. But the sudden and unfortunate passing of Justice Ginsburg has sort of sucked all the oxygen out of the room in Washington. And it doesn't look like there's active negotiations going on. There was a continuing resolution to keep the government funded until after the election, but nonetheless, that is the situation that we were in. Were you to look, for example, at the volatility markets, at what the options markets are showing, you would see that implied volatility, realized volatility, and implied volatility from options. That's the market's prediction of how volatile, say, the S&P 500 is going to be in the coming 30 days, or you can look out further depending on which contract you look at. But markets are predicting high volatility around the election, no surprise, and into December, actually, and that is being interpreted as markets predicting that we may not know who the winner of the election is right away. And that, of course, has a great deal of uncertainty associated with it as well. So big run-up in equities during last 2 or 3 meetings. But now politics and the election are square in the minds of the market. We predicted in our last meeting or two that we thought this would happen, and I think there's more to come in both directions. High degree of uncertainty, and you can see it in your portfolio and in your managers You can see that, the stuff that ran up the hardest is what's being sold off the most here during this time period in recent weeks. The bond portfolio continues to make a little bit of money and having a very strong year in bonds. As you know, interest rates have come down, massive intervention by the Fed. You can see that our blended domestic fixed is up 7.5% year to date. That is a very strong year, especially when you consider the sort of short to intermediate duration of the bond portfolio that we have. So that is some good news there. But the real main driver of performance this month is what we've been discussing, and you can see the value growth differential there. And I think we're going to have to continue to expect that with the election 40 days away. So markets are on edge. There's a great deal of uncertainty about who will win, what will policy be, et cetera. And I think that's going to continue for a while. And yeah, I think you'll continue to see similar behavior, large swings in both directions here in the coming weeks and months. So I'd be glad to answer any questions on that, but sort of a straightforward interpretation of what we're showing here. Good diversification has helped the portfolio again. S&P down over 5%, portfolio down 2%. If there's any questions, Mayor, or areas to emphasize or clarify, I'd be happy to do so.
Thank you, Eric. So, Eric, the most glaring thing for me, I'm looking at the S&P for the, 1 year trailing average. Is at 21%, and our total fund is at 4.7%. I know that is not, apples and apples. But can you help to explain, the significance of the? Well, can you help to explain the difference there, and how that ties into what we've elected to be our approach and strategy with these funds?
Sure. Well, yes, you're correct. S&P is, of course, a 100% equity index, and we have quite a bit of bonds and alternatives, et cetera, for diversification and safety and risk reduction purposes. So that's part of it. And the S&P has been dominated by growth, the large cap, mega cap growth stocks. The numbers are really shocking in the last, say, year or so. You look at what Apple and Amazon and Google and Microsoft and Facebook, those types of stocks have done. They are up enormously, 50, 70, 100%. Whereas you look at banks or energy or other industrials, they're down, perhaps over this time frame. So it's really globally this story of sort of mega cap tech / growth doing very, very well, especially when the pandemic set in. And that's really, and value, not really. That's the main driver of that. We have a significant amount of fixed income, both domestic and internationally. We have some alternatives, but the real driver of that big spread that you see there is sort of the value growth, sort of tech, mega cap tech, and everything else that's driving it. You can see, for example, our mid cap value ETF is down 2% over the last year. So small cap value passive exposure is down over 5%, while the S&P is up 21%. So it's really the diversification of the portfolio with value and growth and different capitalization sizes and international exposure as well that's driving that spread that you rightfully point out.
Okay, thank you. Any other questions? Commissioner Winkleman?
I got to get unmuted. A couple questions. One, first of all, I know we asked when we were way down, should we take some money out of the market? And now's the time to ask if you're gonna, I'm just asking that question. Is there any recommendation on that? Because I think we're going to see more volatility in the next year.
Yes, back prior to the onset of the pandemic, we had this talk. The board considered that, and the board decided to stick with its long-term strategic asset allocation, and they have done so in the other times in the past. So, there have been some tactical, tilting, et cetera, across the years, and the board could certainly consider that. But the last time, and when it was even, back in February, when it was much more intense than what came in March and April, the board decided to stick with its long-term strategic asset allocation, which I should say that the vast majority of other municipalities chose to do as well. So I think it's worked out for you, but it does mean that you suffer, the volatility that the broad markets give, with this month being an example of it.
Eric, this is David Hirsch. I have a question. If you go to page 9, which is a better apples to apples comparison because it's comparing our blended benchmark with our actual performance. Could you speak to the attribution of why we so underperformed in the trailing 1 year to our blended benchmark?
Some of it is due to our hedge fund exposure with very, very recently Renaissance, which has been maybe our strongest performer over the last 10, 15 years, underperforming. That's part of it. Some of it is as we've shifted more towards passive, in recent times, maybe some of the managers who are outperforming aren't adding, some that were underperforming aren't detracting. So that has a way of canceling it out. Also,
I don't understand that answer. If we're in an index fund, then in the trailing 1 year, we should more closely track our index than not.
Well, yes, the index funds themselves will track their particular index, which may be slightly different than the actual index in the benchmark. That's come up in the past before. So, for example, if you look at the Vanguard Large Cap Value Index Fund, its actual index is the CRISP fund, is the CRISP index, but we judge it against Russell 1000 value. Some of that happens with some of these indices as well. So that's part of the answer as well.
But this is almost a 40% underperformance. The CRISPs versus the Russells aren't that different. I think it would be helpful for the next meeting or maybe after this meeting, if you could do a little attribution and see why we underperformed by such a huge percent to a blended index.
Well, the Renaissance piece is got to be what do we use as the Renaissance index?
Hedge fund at HFRI, I think.
Right, but I will give you the blended attribution analysis. Some of it is due to Brandis, for example, which is we've had this discussion before. Remember, Brandis is a large allocation. We judge it for index, for benchmark comparison purposes against the EFA, but of course it's deep value. So Mr. Hirsch, for example, rightfully pointed out that we should see how it's doing against the value, the EFA value index. So for example, if you were to look at page 27, you could see the large difference in EFA versus EFA value. That's been a big spread. So EFA value year to date is down 14.5, but standard EFA is only down 4.6. Brandis is down 15. That type of a thing. Or trailing 1 year, EFA's up 6.1 and EFA value is down 3.2. So that's a contributor too. So it's sort of the actual components of the benchmark versus sometimes the slight differentials that have been chosen on purpose of what the manager or even the indexed strategy is versus, it may have a slightly different index. All of those things added up are what really leads to it.
Yeah, I can see because Renaissance is about 12% of the portfolio with a 16% decline. So that accounts for almost 2%, maybe 1.8% of the underperformance.
Yes, that's true. So it's weakly correlated to markets. It has been over time. You could look at page 35 if you wanted to see Renaissance's numbers over the long period. They're actually very strong. Well, they clobber the long-short index, but we're really looking from that to sort of beat indexed sort of S&P type exposure, which it has done over its lifetime. But as you correctly point out, over the last year, it has underperformed. This has happened a few times over the last 15 years. I expect it'll happen again, but every other time they have come back very strong. Again, it is uncorrelated. It's long short, so there will be times like this, but you correctly identify that as a contributor as well.
Eric, can you put that together for the next meeting, please? Help us just dive deeper into, what helps to explain the difference between our fund and the benchmark for the trailing 1 year average.
Sure, be happy to do so.
Yeah.
Great. Any other questions? Any comments? Thank you for that, John and David. Okay, so if there are no other comments or questions, I'll entertain a motion to accept the investment performance analysis as just delivered by Eric. Is there a motion on the table?
So move.
Second, Mayor.
So moved by Commissioner Winkleman, seconded by Councilman Igliozzi. Any discussion on the motion? All those in favor, please say aye.
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 Are there any opposed? Okay, the motion carries and the investment performance analysis is approved. Thank you. Thank you, Eric. We'll move on to the number 2. Give me 1 second. Let me bring it up here. So move on to matter number 2 on the agenda, discussion relative to the Dexter donation fund and other trust accounts. We'll hand it back over to you, Eric.
Thank you, Mayor. So if you turn to page 1 of that package, we can update you on the various trust accounts. We start on page 1 with the Dexter Donation Trust. You can see it is also down this month, down 2.5%. You can see the same value growth spread month to date. It is, again, it has no alternatives in it. It is with more equity, less fixed income. It tends to be about an 80-20 mix across time. But again, if you look in your month to date and your year to date numbers, you'll see again it's only down 40 basis points year to date, but you see the value growth differential. We have a very large amount of passive exposure in this portfolio, and you see the Vanguard Growth Index year to date through the September 18th is up 21.5%, and Vanguard Value Index is down 9.6. So that sort of tells you the story. It's more of the same story, the same understanding and the same explanatory variables that we've discussed earlier in the call. But we have no recommendations for change of the asset allocation at this time. I'll take questions if there are any.
So I have a question, not necessarily related to the investment performance, but I'm looking at the value of I'll just take the Dexter Donation Trust. So back in 2011, it was 1.75 million. It's now up to 2.9 million, which is great. And we've had it used to be in the past that it would be drawn down and in grants to the community as the fund increased in value. So if it earned 10% that year, we would hand out about 10%. And if it did less, if it performed worse during that year, then the grants would be less that year. We changed our policy to now be between 4 and 5%, I believe, of the total fund balance, which I think is the right approach to have a policy around how much is drawn down each year, independent of how the fund does. But a question for you, Eric. Looking at the way that this fund has grown, is there a sort of a benchmark or a rule of thumb for how to make sure that these, in terms of how much to draw it down, so that you can make sure that it's there in perpetuity, but at the same time that it's supporting as many grants as possible during times of need?
Yes, Mayor. So some background that may be helpful. Most foundations, sort of zero in on about a 5% spending rule. You would see that pretty commonly across various types of foundations and charitable endowments, etc. But those charities and foundations are also, constantly and routinely raising new money for those charitable efforts. These are sort of one-time gifts that have been given, in this case, a very long time ago. So these portfolios were built with sort of the 3 to 5% spending rule in mind that you mentioned. So yes, it has been. Of course, it has been the stated interest of the board to make sure that they last in perpetuity, with interest rates where they are now, very low relative to history. That sort of 3 to 5% rule probably, would be sustainable in the long run. And as the portfolio grows in size, that 3 to 5% is a bigger number and tends to grow with the portfolio. So that's sort of been the approach on average that I think these boards and yourself at the commission level have taken with respect to the spending profile and the risk return trade-off of the asset allocation itself, if that's helpful, if that's answering your question.
Yeah, that's helpful. Thank you. Any other questions for Eric? All right. Well, if there are no other questions, I'll ask for someone to move to approve the investment performance analysis for the Dexter Donation Trust and other trust accounts as just given by Eric. Is there a motion on the table?
I make that motion.
Motion made by Commissioner Igliozzi, seconded by Commissioner Winkleman. Any discussion on that motion? All those in favor, please say aye.
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 Any opposed? All right, the motion carries. Thank you very much. And we'll move on to matter number 3, discussion relative to claims and litigation. I believe that there are no discussions relative to claims and litigation that we have to take on now. Is that correct, Ken?
That is correct, Mayor.
All right. And so I'll entertain a motion to continue matter number 3 until our next meeting. Is there a motion?
So moved.
So moved by Commissioner Igliozzi, seconded by Commissioner Winkleman. All those in favor, please say aye.
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 Any opposed? All right, the motion carries. That matter is continued. I'll entertain a motion to adjourn.
So moved.
Commissioner Winkleman, that was a fast hand.
Second.
And seconded by Commissioner Igliozzi. All those in favor, please say aye.
Aye.
Aye.